Look at your screens and listen closely, because the markets are shifting faster than ever, and if you aren't paying attention right now, you are going to be permanently left behind. Today is Sunday, April 19th, 2026. The weekend is drawing to a close. The financial districts of the world are eerily quiet, but beneath the surface, the architecture of the global money system is silently cracking. Tomorrow morning, the opening bell will not just signal the start of another routine trading day. It will mark the detonation of a sovereign and corporate financial time bomb that has been ticking for decades. We are standing on the precipice of a systemic supply shock, the likes of which modern industrial capitalism has never witnessed. A moment where the illusion of infinite paper wealth violently collides with the hard, undeniable limits of the physical earth. Hello everyone, I'm John A.G. and welcome back to Master Macro. If you want to stay ahead of the next economic wave, hit that subscribe button right now. Make sure you watch this video until the very end, because the data I reveal in the final minutes changes absolutely everything about how you will perceive value, wealth, and the very survival of the modern technological industry. The prevailing narrative of our entire financial system is being rewritten before our very eyes under a singular, terrifying banner. Silver holds above $80 heading into Monday. Samsung, Tesla, and Apple are locking up physical silver directly. Unexpected market on Monday. This is not merely a sensationalized story of speculative price action or fleeting algorithmic momentum. What we are discussing today is a profound, irreversible structural paradigm shift in the global economy. For generations, the price of precious metals has been dictated by paper contracts traded on the COMEX in New York and the London Metal Exchange. These institutions operate on a fractional reserve system, where hundreds of paper claims exist for every single physical ounce of metal sitting in a vault. It was a brilliant system for managing price volatility and providing liquidity, as long as everyone agreed to play by the rules of the paper illusion. But the rules have changed. We have entered a new era, a 2026 reality where the world's most powerful technological behemoths have realized a terrifying truth. Paper derivatives cannot conduct electricity. You cannot build a solar panel with a futures contract. You cannot manufacture an advanced semiconductor with an unallocated metallic account. And you certainly cannot construct millions of solid-state electric vehicle batteries with promises printed on a screen. We are witnessing the quiet, ruthless, and desperate vertical integration of corporate giants. Driven by the insatiable demands of the artificial intelligence revolution, the massive build-out of high-efficiency solar grids, and the electrification of global transportation, companies like Samsung, Tesla, and Apple are in a state of silent panic. They have run the actuarial models. They have looked at the global mine supply, which has been stagnant or declining for years due to underinvestment, geopolitical instability, and declining ore grades. They have compared that constrained supply to their own exponential demand curves, and the math simply does not work. The physical metal is running out. And so, these apex predators of the corporate world have decided they can no longer trust the fragile, highly leveraged promises of the global exchanges. They are bypassing the open market entirely. They are stepping over the bullion banks and the speculative traders, going straight to the source. They are signing massive, multi-year, direct offtake agreements with primary silver miners in jurisdictions like Mexico, Peru, and Australia, locking up the physical metal before it ever sees the light of an exchange vault. Understand the magnitude of this shift. When Apple designs its next generation of spatial computing hardware and advanced neural engines, it requires silver. Silver is the most conductive element on the periodic table. It is the gold standard for thermal and electrical conductivity. There is no substitute. When you are engineering devices at the nanometer scale, dealing with immense heat generation from AI processing chips, you cannot use copper. You cannot use aluminum. You must use silver. Apple's supply chain managers, arguably the most sophisticated logistics operators on the planet, understand that a disruption in silver supply halts their entire production line. A single missing ounce of silver could delay millions of units of high-margin electronics. To prevent this, Apple is weaponizing its massive cash reserves. They are not buying silver to speculate on its price. They are buying it as an existential insurance policy to guarantee their own technological survival. Tesla's predicament is even more acute. We are not just talking about the silver paste used in the electrical connections of their vehicles. We are looking at the massive energy infrastructure they are building globally. Tesla's Megapack utility-scale batteries, their solar roof tiles, and the entire ecosystem of their virtual power plants require staggering amounts of silver. Elon Musk and his engineering teams know that the transition to a sustainable energy economy is completely bottlenecked by the availability of this specific metal. By locking in direct physical delivery from the miners, Tesla is ensuring that while their competitors are forced to halt production lines and pay extortionate spot prices on the open market, Tesla's gigafactories will continue to hum. They are securing a permanent physical moat against their rivals. Then we look at Samsung, a titan that bridges both heavy manufacturing and hyper-advanced semiconductor fabrication. Samsung SDI is leading the charge in next-generation battery technology, while Samsung Electronics remains the backbone of the global memory chip market. Their industrial footprint consumes thousands of tons of silver annually. By directly vacuuming up the primary mine supply, Samsung is effectively starving the secondary market. This is corporate warfare waged through supply chain dominance. These companies are transforming from consumers of raw materials into quasi-sovereign entities hoarding strategic reserves. They are acting exactly like central banks accumulating gold, but they are doing it with the most critical industrial metal on Earth. The implications of this direct offtake strategy are cataclysmic for the traditional financial system. When the titans of industry systematically drain the supply chain, the fractional reserve pricing models of the past become instantly obsolete. The paper market relies on the assumption that if physical delivery is requested, the metal can be sourced from the open market. But what happens when the open market is empty? What happens when all the primary production has already been spoken for, locked in vaults controlled by Tim Cook and Elon Musk? The COMEX is suddenly exposed as a naked emperor. The hundreds of paper claims chasing every physical ounce will violently collapse into a singularity of panic buying. This brings us to the $80 threshold we are seeing as we head into this fateful Monday. $80 an ounce is not just a psychological resistance level. It is a mathematical breaking point for the short sellers. For years, massive institutional trading desks have suppressed the price of silver by flooding the market with paper shorts. They have profited immensely from the volatility, squeezing the retail investor and the smaller mining companies. But you cannot short squeeze a corporation that has a $2 trillion market cap and demands physical delivery. As silver holds its ground above this critical $80 mark, the margin calls are being generated in the dark pools of the financial centers. The institutional shorts are bleeding, and their panic will be the fuel that ignites the rocket. Tomorrow's market open will be entirely unexpected by the mainstream financial media, who are still obsessed with central bank interest rate dot plots and superficial employment data. They are entirely missing the underlying physical reality. When trading resumes, we are not just going to see a gap up in the price. We are going to witness a fundamental repricing of the metal based on its physical scarcity rather than its paper abundance. The algos that trade based on historical moving averages and standard deviations will fail because they are programmed for a world of infinite liquidity, a world that ceased to exist the moment Apple and Tesla bypassed the exchange. You must look at the broader macroeconomic picture of 2026 to truly grasp why this is happening now. We are living through the consequences of the greatest monetary expansion in human history. The fiat currencies of the world, from the dollar to the euro to the yen, have been debased at an accelerating rate. Inflation, once thought to be a transitory ghost, has become a sticky, systemic rot consuming the purchasing power of the middle class. In this environment, capital is desperately seeking a safe harbor, but the traditional safe harbors are no longer safe. Sovereign debt, once considered the risk-free asset, is now widely recognized as return-free risk. You are guaranteeing a loss of purchasing power by holding government bonds yielding less than the true rate of inflation. In response, smart capital has been migrating into hard assets, real estate, agricultural land, and precious metals. But silver possesses a dual identity that makes it uniquely explosive in this specific macro environment. It is both a monetary metal with a thousands of years history as a store of value, and it is an indispensable industrial commodity driving the technology of the future. It is the collision of these two identities that is creating the current crisis. The monetary demand from investors seeking an inflation hedge is meeting the industrial demand from corporations seeking a technological lifeline, and they are both bidding for the exact same vanishing pool of physical metal. Let us dig deeper into the geopolitical fractures exacerbating this crisis. The world of 2026 is a multipolar battleground. The BRICS nations have aggressively expanded, establishing alternative trade settlement mechanisms that bypass the Western financial hegemony. These nations control a vast percentage of the world's natural resources, including a significant portion of silver mining output. We are seeing a rise in resource nationalism, where governments in Latin America and Africa are demanding a larger share of the profits from the extraction of their sovereign wealth. Export taxes, quotas, and outright nationalization of mining assets are no longer fringe theories. They are active policy discussions. This means that the supply of silver reaching the Western exchanges is not only being consumed by the tech giants, but it is also being choked off at the source by geopolitical maneuvering. Think about the sheer scale of the artificial intelligence infrastructure currently being deployed. The data centers required to train and run the next generation of large language models are consuming energy at a rate that is destabilizing regional power grids. To power these massive server farms, tech companies are desperately investing in dedicated solar and wind farms. Every single one of those solar panels requires a paste made of highly purified silver. The silver is used to conduct the electrons generated by the photovoltaic cells out into the grid. There is currently a massive global push to increase the efficiency of these panels, transitioning to newer technologies like TOPCon and heterojunction cells. These newer, highly efficient solar panels require up to double the amount of silver per watt of power generated compared to older technologies. The AI boom is inextricably linked to the solar boom, and both are totally dependent on the silver supply. Now, combine this with the electrification of the global vehicle fleet. An average electric vehicle contains roughly 3 times the amount of silver as an internal combustion engine vehicle. It is used in the myriad of electrical connections, the battery management systems, and the advanced autonomous driving sensors. As the automotive industry transitions to solid-state batteries, which promise longer ranges and faster charging times, the silver loadings per vehicle are projected to increase even further. When you aggregate the projected demand from just the solar and EV sectors over the next 5 years, it completely eclipses the projected global mine supply. This is not a theoretical deficit. It is an absolute mathematical certainty. This is the exact data set that the risk management teams at Samsung, Tesla, and Apple have been analyzing. They are not waiting for the market to signal a shortage. They are proactively creating the shortage by hoarding the available inventory. By signing these direct offtake agreements, they are essentially pulling forward years of future demand and locking it away in private vaults. This creates a terrifying dynamic for any manufacturer who has not secured their supply. If you are a mid-tier electronics manufacturer relying on just-in-time delivery from the open market, you are about to face an existential crisis. You will be forced into the spot market to bid against hedge funds, retail investors, and panic-stricken shorts, driving the price to unimaginable heights. The history of financial markets is punctuated by moments where the physical reality shatters the paper illusion. We saw it in the nickel market in recent years, where a massive short squeeze broke the London Metal Exchange, forcing them to halt trading and cancel billions of dollars in trades to protect the clearinghouse. What is setting up in the silver market right now is orders of magnitude larger and infinitely more systemic. Nickel is vital for steel and batteries, but silver is the nervous system of the entire modern digital economy. If the silver market breaks, the shock waves will reverberate through every sector of the global supply chain. When the Asian markets open their electronic trading sessions on Monday, followed by the European bourses and finally the New York Open, the tension will be palpable. The algorithms that drive high-frequency trading will struggle to process the lack of liquidity. Every sell order will be instantly absorbed by an insatiable bid. The institutional players who are caught on the wrong side of this trade will face a brutal choice. Either cover their short positions at whatever price the market demands, accelerating the upward spiral, or face catastrophic margin calls that could liquidate their entire portfolios. The $80 price point we are hovering above is a historical anomaly only if you look at the last 40 years of managed paper markets. If you adjust the historical highs of the 1980 Hunt Brothers squeeze or the 2011 peak for true inflation, the actual expansion of the M2 money supply over the decades, $80 is incredibly cheap. It is a severe mispricing of a scarce, depleting asset. The market is currently undergoing a violent correction to rectify this mispricing. The tech giants are the catalyst, but the underlying fundamentals have been building for a generation. For the everyday observer, this is a masterclass in macroeconomic reality. It demonstrates the ultimate futility of attempting to print prosperity. Central banks can create trillions of currency units with a keystroke, but they cannot print a single ounce of physical silver. They cannot print energy, and they cannot print industrial capacity. As the fiat system reaches its mathematical endpoint in 2026, choked by unpayable debt and relentless inflation, The market is aggressively remonetizing hard assets. Silver is leading this charge because it is the most undervalued and most strategically necessary asset on the board. You must ask yourself how you are positioned for this paradigm shift. Are your assets held entirely within the digital, fractional reserve banking system, exposed to counterparty risk and currency debasement? Or do you hold tangible wealth, assets that exist outside the banking system and carry no counterparty liability? The actions of Apple, Tesla, and Samsung should serve as the ultimate warning siren. When the smartest, most well-capitalized entities on the planet stop trusting the paper markets and demand physical possession of their critical assets, you must pay attention. They are front-running the collapse of the fiat pricing mechanism. The unexpected market open tomorrow is just the beginning. It is the opening salvo in a prolonged battle for physical resources. As the price climbs past 80, past 100, and beyond, the media will blame speculators. They will blame supply chain bottlenecks. They will blame everything except the root cause, the failure of the debt-based fiat money system and the inevitable return to tangible value. The direct offtake agreements we are analyzing tonight are the corporate equivalent of a bank run. It is a run on the physical vaults of the global exchanges. And just like any bank run, the ones who panic first are the ones who survive. I urge you to look beyond the daily price action and understand the structural forces at play. This is not a trade. It is a wealth transfer of historic proportions. It is the transfer of wealth from those who hold depreciating paper illusions to those who hold scarce physical realities. The industrial demands of the future, AI, green energy, advanced robotics, are non-negotiable. They require the physical elements of the earth. As we stand on the brink of this new week, the battle lines have been drawn not by armies, but by corporate treasuries securing their supply chains. The paper market is dying, and the era of physical dominance has arrived. Thank you for joining us on this deep dive into the unfolding economic crises of 2026. Keep your eyes strictly on the tangible, aggressively question the paper promises of the legacy system, and until next time, good night.